Jonny, you've been a recession denier for almost 3 years. Tell me, what you're thinking now, bearing in mind that theory is being put to the test.
Yeah, it certainly is being put to the test. Tariffs will slow growth. They're going to increase prices. They're going to throw sand in the gears of global supply chains. And they're not really going to raise that much in tax revenue. But I still think the US has enough momentum to be able to get through this year without a recession.
Hi everybody, welcome to another podcast from Super Macro. My name is Elvis, as you probably know. Sitting opposite me is the heart and soul of Super Macro, Jonny. How are you, Jonny?
I'm good, thanks. How are you, Elvis?
Yeah, good. What do you want to discuss today, Jonny? What's really on your mind?
Of course, the same as what's on everyone else's mind, the impact of tariffs.
Yeah.
And what we're seeing at the moment, of course, is the most obvious impact is collapsing business and consumer confidence. I think business hiring and CapEx plans are being put on hold. And the market, of course, is very fearful of the outcome, the impact on corporate profits. The other secondary effects that are non-negligible are the wealth effect on consumers. If the stock market continues to go down, it will have a negative impact on household wealth and on consumer spending.
Do you think that the amount of it seems to be happening in such a short period of time that Trump is attempting to change things that would normally have taken years, if not even a decade? He wants to change it in as many weeks. Is that really what the CEOs are fearful of, the abrupt change?
I think what is most concerning is not even the tariffs themselves. It's the flip-flopping, the uncertainty that they're creating. And so inflation expectations are going higher. We see that in the Michigan survey. We've got another survey out tomorrow. This is being recorded on Thursday, so we'll see if they've inched up any further. And businesses, of course, really have a very uncertain future. The most vulnerable industry is the car industry, and I've looked at various studies that show the components that go into making a US automobile crisscross the Canada US and the Mexico US border several times, even fairly simple components. And a component like an engine or a transmission system can cross those borders 7 or 8 times before it ends up in a car. Now, if you're going to apply tariffs each time those components cross the border, then the first thing is the US auto industry is going to have to completely restructure its supply chains, and it will add, that I've seen estimates of $12,000 to a car.
It's going to add something at least. Yeah.
So
probably a material number rather than a small number. Yeah.
It really will hit that particular industry very, very hard. As a first pass, I've got some estimates from Yale Budget Labs. Anyone can look at this. If you go into Yale Budget Labs, they've done various estimates for the impact of tariffs. And just in a nutshell, the long run impact is that tariffs, along the lines of those that have been proposed, will slow growth between a third and 0.6% each year. This is an ongoing reduction in GDP growth. And they'll raise the price level by between 1.66, I just love the accuracy, and 2.07. This is clearly done by academics.
But it's going to hit the poorest, the lower percentile earners the most.
Yes, it's a very regressive. Yeah, it's a very regressive tax in that those at the lower end of the income distribution are going to feel it most. If you're a multimillionaire, you're not really going to care that too much about tariffs on goods. So this is just first pass estimates of the damage that will be done. Not catastrophic, but not great. Perhaps you might say it's a price worth paying for getting the fiscal and trade deficits under better control.
Do you believe in that? Do you believe that's true? Obviously, ultimately, that is going to be Trump's ultimate aim. But there's a lot of pain to go through to get there.
Yes, I agree. I'm not sure that tariffs are the best way to go about it. The whole economic theory of relative advantage and trade suggests that, but all countries are better off if they trade with each other. You do what you do best. And just to give you an example, 80% of the avocados consumed in America are imported. Now, you could grow the avocados in California, but nobody's going to pick them for the kind of wages you want to pay.
Yeah.
And we have 4.1% unemployment in the US. Unemployment is very, very low. There's more than enough jobs for every unemployed worker, more than enough vacant jobs. So Americans are employed in higher paying industries, and there is low cost labor elsewhere that will do these jobs that Americans won't do.
That's the whole point of trade, isn't it?
That is the whole point of trade.
And so can we say, essentially tariffs work if they're a bullying tactic? You get some concessions, you go back to the American people, say, look what I've got for you, we've done this, no tariffs, and we move on with a better deal for us.
Well, I had hoped that Trump was going to use these tariff threats to wring concessions from his trading partners.
It's done the opposite. The opposite seems to be working now, isn't it? Unfortunately.
Yeah, it seems now we've got retaliation, and every time there's a bit of retaliation, he just ramps up the
his
tariff
rhetoric.
threats.
He thinks it is rhetoric, and what he threatens to do will make them stand down. My suspicions are if the S&P dips further from here, or NASDAQ, S&P, whichever one he has particular interest in, he'll probably blink.
Well, I do want to emphasise, and I'm going to jump ahead to a later slide in this presentation if I can find it. The idea that tariffs might get manufacturing back in the US is just a complete fallacy.
Really?
Yeah, I mean the amount of onshoring that you're going to get of manufacturing is minimal. This chart here shows manufacturing employment as a percentage of total employment. And you can see since, well, this goes back to the 1960s, but it's been on a continuous downtrend. It's kind of flattened out now at about 8% of total employment. You're not going to be able to get that back up with tariffs.
A lot of that is structural, isn't it? We know we're moving towards a service-driven economy, and that's where the hiring will be. But some of that is going to be the fact that low-cost producers have been out there for many years: China, Vietnam, etc.
Yes, but it's like I said, this is comparative advantage. You have low-cost labor there doing jobs that Americans probably don't want to do anyway. You might as well use it. While in America, the more highly skilled, better paying jobs are the ones that Americans are going for, are able to fill.
Essentially, you're telling us, Johnny, or you're implying that the tariffs are pointless. Would that be a fair reflection?
Well, I wouldn't say pointless. I think with the tariffs that I think will go into place, the US should be able to raise tax revenues by perhaps 100 to 200 billion a year from tariffs. These are rough estimates. And I think maybe, certainly for example, the aluminium and steel production, that can be done in the US without too much trouble. And the tariffs will help with those particular industries. It's more for the more It's more the industries with really complex supply chains that I think
could suffer.
Are really going to suffer. Yeah.
You mentioned the auto industry.
Yeah, but if I look at the impact on consumption, and I've got another chart here so we can get some kind of perspective on this. So US consumption it's 68% services and 32% goods. And of those goods, about 20% are imported. So now you're down to about 6% of US consumption is imported goods. And of that 6%, roughly equal amounts come from China and Canada, 13%, and 16% from Mexico. So if you assume 25% tariffs on all these, it doesn't have a massive impact
on the GDP.
On prices. primarily on prices. The GDP hit comes because you're pushing up the level of the price index. You're effectively taking spending power away from consumers. They're going to get a hit to their effective disposable income.
So the inflection, the inflation part of the GDP goes higher. Therefore, the real GDP comes lower.
Yeah, I mean, in theory, the central bank should look through a one-off price hike. Let's just say this budget lab model is correct. So let's say prices go up by 2% in the year after tariffs are imposed. That's a one-off price hike. The central bank should look through that and say, well, okay, it's not inflation. It's just a one-off adjustment.
So reset once and that's it.
But that's fine in theory. I think what will happen in practice is that 2% increase will be spread over time, because everyone will eat a little bit of the price increase in their margins, whether it's the exporter, the importer, or the distributor in the first year, and then try to rebuild margins over the following years.
Right. Okay.
So that's the first.
The consumer
impact.
won't take the hit straight away.
No.
The hit straight away.
Exactly. So there'll be further price increases, but I think also the fact that you will put so much disruption into supply chains, and they will have to be reconfigured over time. There'll be a continuous process of steadily increasing goods prices, because you won't have the same sort of import penetration from the low-cost producers.
Right.
That will stop. So I think they are inflationary. We haven't seen it yet. We just had the PPE and the PPI and CPI prices. Goods prices in both of these have really stopped declining. So now goods price inflation has flattened out. It will start increasing over the next few months. Goods prices were a drag on core inflation. So that's ended. Other factors will offset that, slower rental inflation and so on. But, it's a question of which ends up being having a bigger impact, whether the increase in core prices outweighs.
What do you think?
What do I think? I think it, the slowdown in rental price inflation, it is not going to last that much longer. Rental price inflation in the CPI is
strange way it's calculated as well. It's not I won't say accurate, but it doesn't seem to be a good way to put it.
It's not a very
reliable,
good real-time measure.
Yeah,
there are
the Zillow measure. Would
Zillow,
you take?
Yeah. But the Zillow measure of rental price inflation is 3.5%.
And it's been flat for some time. It hasn't been coming down.
It's actually beginning to creep up.
Is it really?
The CPI measure of rental inflation is 4.3%, I think, and it hasn't got much further to slow. So you're not going to get the benefit of slowing rent inflation for much longer. So to put it in a nutshell, we're going to have slower growth and higher prices and higher inflation. And what are the benefits? Well, there will be some onshoring of manufacturing jobs, not much. But I think the damage done to other industries and the halt to employment growth as a result of business uncertainty is going to outweigh any benefit from reshoring of manufacturing jobs.
Will they get a friendly Fed on the assumption that employment will be affected at some stage, which it hasn't seemed to be, but it might be affected at some stage in a material way, which will, I assume, is what the Fed's cue to cut rates?
Yeah, I think, the problem is for the Fed, that will take a long time to show up. And right now, the Fed is probably more concerned about the impact on inflation. So the Fed is going to be on hold for a while. But that's half the story of what's going on at the moment. The other half, of course, is fiscal tightening, which people are concerned about. People are concerned that fiscal tightening with Doge and the cuts that certainly there's a hiring freeze on federal employment and some cuts to federal employment. There is a concern that this fiscal tightening will have an impact on growth.
But I got the impression you don't think it will, or not in the same material way that the market's pricing.
That's correct. I don't. Look, I mean, it will have a small impact, but the fiscal deficit is going to stay wide, and whatever Doge has done is not going to have that much of an impact. I've got a chart here, which I've just grabbed from the Congressional Budget Office,
yes.
their projections. And the important takeaway from this is that the light purple area is the net interest outlays. The darker purple area is the primary deficit. So that's the net government expenditure less the tax revenues before you start adding on the interest bill. And
is this what Bessent's talking about? Getting down the 10-year yield is the most important thing, so they can get that light purple bit down a bit.
Yeah, it's a bit late for that because during the years when yields were sort of 1% to 2%, this wasn't a problem. But that debt will roll off over time, and it's being replaced by debt with coupons of 4% plus.
Right.
And that's the problem. That's why we that, and the fact that the total deficit has grown so much, the net interest outlays are a big percentage of it, and there's nothing you can do about those.
Oh, there is, isn't there? What Trump's proposed, isn't it? What we'll do, we'll tell everybody that owns our treasuries through trade, we'll take those treasuries back and give them a war loan, 0 coupon, and you can use that to borrow money when you need to.
Yeah, I really don't think that's going to happen. I mean, this so-called Mar-a-Lago Accord, if the US was to do that, I think they'd find it very, very difficult to sell debt in the future.
Yeah, I agree.
I mean, it would, it's just a ridiculous
that would
idea.
that would be the cue to sell as many treasuries as you could do at the current price.
Yeah. So there's not much they can do. And of course, we're seeing a lot of news about Doge cuts to this department, that department, and federal employees being laid off or being given voluntary redundancy.
Quite healthy ones, actually.
Well, yeah, they're being paid till October, and then they'll be let go. But it won't make a massive amount of difference to either the labour market or the deficit. Let's just get this in perspective. There are almost 160 million people employed in America. 2.4 million work for the federal government.
Wow. So it's not that, as a percentage, that's not many. And then you cut a small percentage of those, it's tiny for the overall.
Yeah. There's more working for state and local government. But if we look at, everyone focuses on the non-farm payrolls each month. What I've got here is non-farm payrolls broken down by private sector, government, state government, and local government. I can barely
see the government.
Yeah, that's right. It
that's
barely showed. It barely registered. Well, the colours didn't come out quite how I wanted, but the green is the private sector. So you can see about 140,000 private sector jobs in the most recent payroll print. There's steady growth. Obviously, there was a burst of job growth after the pandemic. That calmed down, and we're running at a rate of it bounces around quite a bit, but somewhere between 150 and 200,000. The private sector, the green part, is the vast majority of that job growth. The red is the federal government, which is the bit that's Musk is taking a chainsaw to, in theory. The other bits are state and local government. A lot of that is education, and
so are you saying essentially what Musk, Doge, Trump is instructing him to do is more for the people that voted for him to show they're trying to do something about this rather than having a material effect on the economy?
I don't think it's just for cosmetic purposes. I think the deficit, the CBO projections, the deficit's over 6%, and it's going to stay that way for quite a while.
What's debt to GDP, 100, is it?
Something like, I think it's over 100 debt to GDP. So something has to be done. And I think if you start hacking away at it wherever you can, that's better than doing nothing. And if you can somehow perhaps control entitlements by perhaps not raising them as much as inflation,
right.
If you can do things like that, you can maybe get this deficit down as a percentage of nominal GDP, and that that will over time help to get the deficit down. I mean, it really will.
Well, he's got the mandate for 2 years to try and get something done. I suppose that would be the acid test.
I think just getting back to your question earlier on, do you think he's going to really go nuts and do all this stuff early on? I think now is the time to do it. Now, if you're going to make some dramatic policy decisions, now's the time to do it.
Because his window is not that great, because we assume when the midterms come along, he might not have effective control of everything, of the House and the Senate.
After the midterms, yeah. So now's the time to do it. And so that's what he's doing. And if you look at his first 40 days or so in office, or however long it's been, it's certainly been quite active.
Do you want to take us through some of the one of the major unintended consequences, it seems, of his actions when you start threatening trading partners and what they get at and what they do?
Yeah. So this is what we call making Europe great again.
Yeah, we've mega, right? Mega leads to mega.
So I think with the tariff threats and the tariff actions and the withdrawal of foreign policy from having such a big presence in Europe, it was time for Europe to step up to the plate. They needed to do something.
Needed a catalyst, didn't they?
Yeah, and this has absolutely galvanized Europe into actually doing something, without a doubt. And what Friedrich Merz has done in Germany, he is the soon-to-be chancellor once the new parliament forms, but he's there in the old parliament, and he's going to push through a constitutional amendment to release Germany's debt brake and really, really boost spending. I've got a summary of this up here.
It's quite extraordinary, isn't it? It's a 180
staggering.
degree, and we will do whatever it takes.
Yeah, I don't think the market's really fully priced this in. If you look at the three main changes that are proposed, a relaxation of the debt brake. Okay, that's not quite as big. So the debt brake limits structural deficits to 0.35% of GDP. That will be raised to 0.7%. But the other big two are the off-balance sheet infrastructure fund.
Amazing how it comes off-balance sheet.
Off-balance sheet, so it doesn't count towards the deficit, the debt brake.
They might just get rid of the debt brake, so it doesn't exist anymore because we're going to spend whatever we want anyway.
Well, that's pretty much what he's done, assuming he gets this through the Bundestag. So this 500 billion, I mean, he's proposed 500 billion
over a 10-year period, I believe.
Yeah, to be put into an infrastructure fund, which will be spent over a 10-year period. Now, Germany's GDP is about 4.1 or 4.2 trillion. So 500 billion is over 12% of GDP. That is absolutely enormous. So estimates are that, assuming this kicks in this year and next year, it'll boost GDP by 2 percentage points next year, and probably 1 percentage point per year over the life of the fund.
That's enormous. That's 2 percentage points, not 2%.
Yeah,
2 percentage points. Yeah.
So, and then you have this other thing, the unlimited defence spending, which will so defence spending is also going to be excluded from
That's
the
like
debt
just
brake
pressing
rules.
a B button on the keyboard, isn't it?
Yeah.
Fine. Just keep
by.
do you want to take your finger off the keyboard? No.
The only thing I would say about the defence spending is a lot of that will probably leak abroad, maybe to the US.
Well, 2/3 of the armaments at the moment, I think that Europe has, it comes from the US. So, but I assume they'll change that, or the French will be arguing because they've got quite a big defence industry, haven't they?
Yeah. So I think in terms of the fiscal multiplier in economist speak, it's probably less than 1 for the Eurozone. But
to start with, but that will increase.
Yeah, that may increase. But the two things combined are just gigantic. And to me, it's reminiscent of when Abe was elected Prime Minister in Japan. 3 Arrows, brought in Kuroda to head up the BOJ. And at first, there was a lot of skepticism for what these policy changes would do. But the Nikkei and dollar yen, I mean, just absolutely took off.
Well, dollar yen, what went from the low 80s to over 100, didn't it? I think
Well over 100, something like 120 or something.
Yeah.
Nikkei just went up and up, and I had a correction in June. And at the time, you could argue, well, what he was doing, what they were mainly doing, massive QE, much bigger than anyone expected at the time. I've always had doubts that QE does really have such a big economic benefit
on the real economy, as it helps assets, without shadow of a doubt.
Yeah, but it just takes the market to acknowledge the scale of the stimulus, and things will really take off. And I really think that's the case in
There's a
Eurozone.
big difference, though, isn't there? This time with taking Germany as the yardstick, is the borrowing. Debt to GDP in Germany is, as you're going to probably give me the correct figure, just over 60%. Even if they took that to, I think I read something the other day, took it to close to 85, that's 2 trillion euros, which is a substantial sum of money. And they still won't have as big a debt to GDP ratio as maybe US, France.
Oh, yeah.
UK.
Yeah. I mean, Germany has the fiscal headroom to be
Only
able to
one
do
of the
this.
advanced economies that probably has.
Yeah. And I think probably has what Obama used to call shovel-ready projects. The German infrastructure has been creaking for decades. I should have looked it up before we started this, but there was some bridge about a decade ago that collapsed, and all the road traffic had to be rerouted miles out of its way. It was a massive, massive cost. And that's just one example of the type of problems that this ancient infrastructure is giving Germany. So the projects are there, whether it's new infrastructure or maintenance of old infrastructure. There's a desperate need for this spending.
So, talking about markets and how they're pricing what's happening, I think most people who listen to this would have seen the bund yields ratchet higher, and you're thinking as looking at them relative to US bond yields. What are you thinking there?
Well, first of all, let me start with this. I've been short bunds, as you know. I had bund put spreads, unfortunately, and obviously the news sent the bund right through the lower strike.
That's just not quite as we planned.
No, but still made a decent amount of money. But my thinking, I was pretty convinced that the ECB would not take the deposit rate below 2%. If we look at market pricing, I'm showing there in the dotted red line.
Oh, I see. It's moved a lot, isn't it?
It's moved a lot. Yeah. But, at the end of February, it was pricing in a deposit rate of 175 from the ECB. The market rates still price more cuts in the deposit rate that will take it.
So where's the deposit rate at the moment?
2.5%.
2.5. So and the market's pricing in from there looks like
another, it's
3-ish.
Well, 2 and a bit, I would say 2 and a bit cuts now.
And you don't think it goes below 2%?
No, I think it goes. I think the April meeting will probably be a pause. Yep. I think the Hawks have got enough ammunition to really push back.
There's too much unknown at the moment. What's going to happen to spending, etc. Yeah. Okay.
Inflation did surprise to the upside. We've just seen industrial production beginning to turn the corner now. I don't know how long that will last once the tariffs hit, but we'll see.
We've got a consumer with plenty of cash in the bank and record low unemployment.
Low unemployment, absolutely. And savings rate is very high. We're seeing consumption beginning to pick up. We saw that in the GDP figures.
Ingredients are there for something to change materially.
Yep. And that's before you take account of Germany pushing this fiscal spending through. And it's not just Germany. It's the whole of Europe,
And you might have a lot of cheap Russian energy coming in the market at some stage if Trump gets his way and pushes Zelensky to make a deal, and that's it.
Yes, so it'll all help the Eurozone quite
feels like there's a few green lights showing there, and we know there is problems with the Eurozone, isn't there? You've got 27 member states can barely agree on anything, but perhaps this time they'll all see sense and saying, this is the way to go forward if we want prosperity.
Well, the fiscal pact, I think, has been thrown out the window. It was a little while ago, but now this just reinforces it. Now the rules are going to be changed so that if you're spending on defence, that comes outside of the guidelines for the deficit to GDP has to be below 3%. And if it's above that, you're supposed to go under a procedure to get it back down to 3% of GDP.
That ain't happening anymore.
That's not happening anymore.
What they'll do, they'll find one of those rules that they've written that they say we don't have to look at that anymore.
Well, also the great taboo was common debt issuance. The Germans were dead set against it, but we're moving towards that now. So I think it's quite a dramatic change in Europe that will have a big impact on markets.
Do you think that, just an aside here, that the UK is going to get closer to Europe now? Because I suppose with the fact that Trump is seen as the the mini Satan out there who's changing everything around, the UK can become friendly to Europe it suits both parties.
Yeah, it's like the enemy of the enemy of my enemy is my friend.
Brexit. Well, what about Brexit? We're not interested in that anymore. But come and sit down at the table with us, sort of thing.
Yeah, and they are. They're going to do more joint defence projects and so on.
Well, Britain's got the nuclear deterrent, which is what Europe probably wants most of all.
Yes, yeah. Well, the French have got it as well. So, as far as markets are concerned, I think there's still uncertainty as to whether Merz will get this approved.
Small, though, Johnny. It's such a massive thing to Europe and to Germany. It would be, to me, maybe I'm wrong, inconceivable that they wouldn't get this through.
Well, they do. They are relying on the Greens, support from the Greens in the old Parliament, and so the Greens will get their pound of flesh.
Okay, but if they decide to play hardball, it doesn't go through, and that his government collapses and things go a bit tits in Germany, the Greens will be blamed wholeheartedly for not doing.
Yeah, they'll agree a deal in the end.
Yeah, they know what if they want their political future to be there.
And from what I've read, the risk of a challenge from the Constitutional Court is very, very, very low. I mean, it's a very low risk event.
You assume they're not political, but they will be political in this particular case.
Yeah, but I mean, as far as the markets are concerned, I think the markets still price a risk that the deal doesn't get done. I think once we get an announcement that this is going to go full steam ahead.
See Bunds trading a lot lower.
Bunds lower, European equities higher. Well, certainly to continue outperforming the US.
Infrastructure stuff in Europe is going
infrastructure
to be,
defence stuff very well bid.
Yeah,
and I think the euro as well. I mean, the euro.
Could you say that there's been a lot of chat over the last couple of years, especially since I've been on Twitter. Everybody's talking about the US will slowly use its reserve currency status, but this seems to maybe, although I've never agreed with that, maybe has speeded that process up a little bit.
At the margin, yes, and I think reserve managers will.
Because you'll have a whole load of more bunds to buy. That's been the problem. The liquidity's been lower.
Well, I think they'll be happy to have a higher weighting of euros. The reserve managers will be happy to have a higher weighting of euros relative to dollars in within their asset mix. Certainly, I don't think it's going to speed the demise of the dollar as a reserve currency. Really, the idea that some of these, like the China or some sort of Chinese-Russian mix could take its place is just
that's why they've got the portable goalposts, haven't they? They just switch them around when they feel like it. But you feel as though with Europe as a whole, maybe they've got a better chance of taking a slice.
Well, I think the only way that a country can achieve reserve currency status, apart from being one of the most powerful in the world, but it helps to have respect for the rule of law, a fair judicial system, democracy, freedom of capital, and open and free capital markets. Let's put it that way. Certainly an absence of capital controls, and the likes of China is nowhere near to that.
No, absolutely.
So, the renminbi is not going to replace the dollar.
You got any more chance for us?
Just one more because, and if I could withstand the volatility, I would be long European stocks versus US stocks. I still think that is the right trade to do. This chart this shows the current year earnings per share, and of course you can see EPS. Rolled round into a new year now, so EPS estimates are higher than they were for last year. That's the blue line on the left axis, and the S&P is the red line. And really, just eyeballing that, you can see that the level of the S&P index relative to earnings per share, historic earnings per share or current year earnings per share, is still at quite a premium compared to where it has been traditionally. That's another way of just seeing that the PE ratio has expanded a long way in the last 2 years. So,
and there's an assumption as well, as you see from the blue line, that the EPS is going to hold up.
Yeah, I mean, I think the main thing is that in the last 2 years, the S&P returned 25%, 2 consecutive years, so a total of 50%. Earnings per share went up by 20% over those 2 years. The PE ratio grew by 30%.
Right.
So you got the 50% return.
You've got to pay more for those earnings. It's quite simple.
You got the 50% return over those 2 years, but that's a trick you can't keep repeating. I mean, the PE ratio isn't going to keep expanding. So now I think the S&P 500 relies on earnings per share to continue growing. I think the multiple will contract.
And this year will provide some headwinds to that.
Yeah, so it faces headwinds, and I think really, the point about European equities and UK equities is they start from such a low base in terms of the PE multiple. There's very little expected from earnings per share growth, especially in the FTSE, and I think you could get both. You could get an stronger EPS growth and an expansion in the multiple.
So let's just go on to the bit that I like the most when we talk about what you want to do. I think you've described it anyway, but let me just précis this. US equities are expensive. You don't want to own them. You would want to own protection if the implied volatility is at the right price.
Well, let's put it this way. At the start of this year, I was buying puts and put spreads on the S&P 500. Right. They're too expensive now. The implied volatility is too high now. So, for me, I'm just leaving it alone.
European equities, cheap, obviously have gone up quite a bit in the last year, but still remain cheap. I think with the fiscal changes in Europe, this is going to be the area to own.
Yeah, this is the place.
Yeah,
this
okay.
Is the place.
Fixed income, treasury yields, what are you seeing there?
Well, I was surprised at the reaction from Treasury yields today, but I think if you look at, of course, we just had the PPI numbers. If you look at, this is not me doing the calculations, but PPI and the CPI, those components go in to, they feed the calculation of PCE
the
inflation,
one the Fed looks at.
The one the Fed looks at. And on the face of it, it looks like PCE inflation will tick up from 2.6%. Core PCE will go from 2.6 to 2.7.
So allowing the Fed to sit in their hands properly and do nothing.
Yeah, and the labour market so far,
hasn't
jobless claims.
Deterioration.
It hasn't fallen apart.
220 today, the jobless claims?
Yeah, initial jobless claims. Federal jobless claims, they're reported with a 1 week delay. They actually dropped by 58 or 54 people.
54,000.
No, 54.
54 people.
54 people.
Sorry.
They're only something like 1,600 initial claims for federal employers. I shouldn't laugh.
So Treasury yields,
So Treasury yields, I am. I think if term premium comes back into the Treasury market, this was my idea. Right now, the Treasury yield is close to the overnight rate, and so
there's no term premium.
So there's no term premium there, and I think the Fed's going to be on hold. And I think if inflation starts picking up, you could see a decline in Treasury, decline in Treasuries, a rise in the yields. For the Bund.
The Bund is the one that you're more.
Well, the Bund was at a spread of 205 basis points to the 10-year Bund was at a spread of 205 to the 10-year Treasury. And when I was carping on about shorting Bunds, but that's now collapsed. I don't know where it is right now. Something like 140 basis points, maybe less. Could easily go to 100 basis points as a spread. Actually, it must be pretty. Yeah, it's probably lower than 130. And it could go. It could, in an extreme circumstance, it could go to parity with the
Well,
Treasury
if we get
yield.
a big shift away from investment in the US to investment in Europe,
Absolutely. If we do get a more meaningful slowdown in GDP growth in the US and Europe really
picks up.
then there's no reason why those yields shouldn't be the same.
And just to lastly, the dollar. What are you thinking from here? It's had a bit of a shakeout.
It certainly has, yeah. But again, it's contingent on Europe getting its act together. I think the euro can rally against the dollar, can rally more. I think what the market is pricing in from the ECB will be scaled back. I think there'll be fewer cuts than the market
and
prices.
that'll force euro dollar higher.
Yep. Dollar yen. I'm out of most of my trade in that now. I've been short dollar yen.
It's been largely a play on. It seems to work as a risk off.
Yeah,
indicator.
I think if for me, my reason for doing it was just the rate differentials between the US and Japan were closing, which should put pressure on dollar yen. But in fact, it's also had the boost of the risk off.
Yes.
People go to the yen for some reason. But the volatility, the implied volatility in the options now has picked up quite a bit. So it's
your
time
risk
to get out of
reward
that trade.
using options is
it's
not there.
So good. It's not so good.
Well, thank you, Jonny, very much indeed.
My pleasure. Thank you for joining me, Elvis.
Thank you very much. See you soon, guys.